If you want the simplest breakdown of the top loan programs in 2026, this video is for you. I'm gonna explain every major loan type in plain English so you know exactly which one fits your situation. No confusion, no jargon, no needing to Google what does DTI mean in the middle of the night. Just clear answers. All right, welcome back. I'm Mike Sadikian and I help buyers and investors get the best financing in California and nationwide. This video matters because most people shop for home loans without understanding all of their loan options. It's kind of like going to the grocery store shopping hungry. Everything looks good until you get to checkout. Once you understand these 5 loan programs I'm about to break down for you, buying becomes easier, faster, and a lot less stressful. Let's break everything down in the simplest way possible. All right, the first type of loan that we have is what is called an FHA loan, and I'm gonna share with you exactly when to use them. FHA loans continue to be one of the best programs for first-time home buyers, especially if your credit score is not perfect. Here's an easy way to think about FHA in 2026. Use FHA if your credit score is under 680. Use FHA if you want a 3.5% down payment. Use FHA if your debt to income ratio is higher than normal. Use FHA if you have late payments, collections, or an uneven credit history. Basically, if your credit report looks like life has been lifing, FHA is gonna be your best friend. FHA is more forgiving, easier to qualify for, and often gives you the best possible monthly payment when your score is not very strong. If you want flexibility, FHA is your reliable ride or die. All right, so the second type of loan we're gonna get into is what's called a conventional loan. Conventional loans are ideal for buyers with strong credit. Here's the simple 2026 rule. Use conventional if your score is 680 and above. Use conventional if you want the lowest mortgage insurance. Use conventional if you have at least 5 to 10% down or more. Use conventional if you want the cleanest refinance option later. Conventional rewards strong credit with lower pricing. It's basically the premium member loan, except you can't buy your way in. If you can qualify for both FHA and conventional, I always run the numbers side by side and choose whatever option is cheaper for you. No ego, just straight simple math. Okay, so the third type of loan is what's called a non-QM loan. So we have DSCR loans versus bank statement loans. Non-QM loans continue to grow in 2026 because more buyers are self-employed or investing. Here are the 3 types that you should know about. Non-QM type number 1 is what's called a bank statement loan. Perfect for self-employed buyers who write a lot of expenses off. Instead of tax returns, lenders use bank deposits to calculate your income. Use this if your tax returns look low, but your cash flow looks strong. If Uncle Sam thinks you make $30,000 per year, but your bank account says otherwise, this is your lane. DSCR loans. These are for investors. The approval is based on the income of the property, not your personal income. So if the rent covers the payment, you can qualify in most cases. Use DSCR if you want to scale rentals nationwide without any type of tax returns. It's the closest thing to cheat codes that real estate investors can get. And then we also have other types of non-QM loans. These are asset-based loans. These are 1099 income loans. These are P&L statement loans, all designed for people who earn money differently than a traditional W-2 employee. If your income doesn't fit in a box, non-QM says, no problem, we have other shapes. So if you are self-employed or an investor, non-QM is gonna be the most flexible lane for you in 2026. The 4th type of loan is VA loans. VA loans remain one of the best programs in the entire country. 0% down, no mortgage insurance, very low rates, flexible approval guidelines. If you have VA eligibility, this is almost your best option in 2026. It's basically the VIP get in the front of the line pass for mortgage loans. And then we have the 5th type of program, which is a first-time buyer low down program. Here are the most common low down programs for 2026. 3% down, conventional for first time buyers. 3.5% down for FHA. State and county down payment assistance programs, lender-based assistance programs with grants or second loans. Some programs combine closing costs and help with the down payment. So if you think you need 20% down, you do not. Most first-time buyers in 2026 use 3 to 3.5% down plus a combination of credits, gifts, or assistance. Your parents needed 20% down, usually back in the day. All you need today is a really good lender and maybe a generous aunt or uncle. So let me give you my final thoughts. Every buyer fits into one of these categories. FHA if you want flexibility. Conventional if your credit is strong. Non-QM if you are self-employed or an investor. VA if you are eligible. And low down payment programs if you want the smallest upfront costs. My job is to help you understand your best option clearly so you can buy with confidence instead of guessing. Guessing is for the slot machines, not for home loans. So if you want me to run your numbers and show you exactly which loan program you qualify for in 2026, click the link below. I will personally review your income, your credit, and your goals to give you the most clear plan moving forward. Just clarity, confidence, and a loan program that does not make you want to pull your hair out. I'm Mike Sadikian. Thanks for tuning in, and we'll see you on the next episode.